most of the curve moving below 3%, the long end still above 4. We are pricing in a full 5 rate cuts over the next 12 months. A quick check on FX this morning because we are getting a haven bid when it comes to the yen. The yen stronger versus the dollar. It has been a lot of dollar weakness, though. Look, the euro is stronger versus the dollar. The Bloomberg Dollar Index just barely hanging in there. Are we not yet on the other side of the dollar smile, or has something changed and the dollar isn't getting as big of a bid as it is risk off? But it is risk off this morning. Overall indexes are down. Let's look at some of the individual stocks feeling the pain this morning. Here with us with that is Bloomberg's Joe Easton. Joe, good morning.
Morning, Danny. So I've got my eye on Howmet Aerospace in the pre-market, dropping around 9%. There was a report over the weekend saying the company could potentially declare a force majeure on its products if it's hit by the tariff uncertainty. And we've seen a feed through into the European peers as well this morning. It moves lower across that sector today. Then I'm also looking at Tesla, the long-time bull on the stock. Dan Ives over at Wedbush slashing his price target today, saying the company's brand image over in China is potentially going to be hit from the tariff effects, and therefore some of their competitors in China could do better. Tesla continuing its losses today. And then over in banking, Goldman Sachs downgraded at Morgan Stanley today. The analysts over at MS reckon the company's investment banking business is surely going to be hit by the volatility that we are seeing in the market at the moment. So they cut the rating on that one. Then finally, just going to give a quick shout out for our pre-market opening bell wrap that will be available on the terminal soon from the stocks team to run you through all these moves and more before the opening bell in New York today.
Joe, it is a volatile day. That's so important. I would endorse that sign off to go look at that blog. Joe, thank you so much. Bloomberg's Joe Easton. Just a few minutes in the hour, we're going to be speaking to Iain Stealey of JPMorgan Asset Management. Later in the hour, Alastair Pinder of HSBC joins us. 2 conversations you don't want to miss. But back to our top story, the story of the day. President Trump has told reporters on Air Force One he wasn't intentionally fueling a market sell-off. But he was clear the administration is having no second thoughts. His goal, reduce trade deficits.
What's going to happen with the market, I can't tell you, but I can tell you our country has gotten a lot stronger. And eventually, it'll be a country like no other. It'll be the most dominant country economically in the world. But sometimes you have to take medicine to fix something.
Joining us for the latest on the tariff fallout, Brendan Murray, who leads Bloomberg's coverage of trade, Chief European Correspondent Oliver Crook, and Bloomberg's China Economy and Government Editor Alan Wong. Brendan, I want to start from you. We have heard Navarro, we have heard Bessent, we've heard various people, Trump himself, get out onto the media, talk about what they are doing. It doesn't seem like there's any signs of backing off.
No, not at all. The president and his top economic advisors spoke at length on the Sunday talk shows, and they're sounding as unapologetic as they ever have about the impact that these tariffs are having. We had the 10% universal tariff take effect over the weekend, and we have the much higher reciprocal tariffs taking effect in less than 48 hours. So there's a window here to perhaps the president could soften some of those tariffs, but it doesn't sound like it's going to happen. And obviously the markets are trying to factor in the economic impact of that, the headwinds that will come with slower growth and higher inflation.
It's a hard thing to price in because we are just in the world of economic theory at this moment, Brendan. But Vietnam may be an interesting case study in this. Peter Navarro spoke to Fox yesterday, speaking to the negotiations that have been going on with the country. Just take a listen to what he said.
If you simply lowered our tariffs and they lowered our tariffs to zero, we'd still run about $120 billion trade deficit with Vietnam. And the problem is all of the non-tariff cheating that they do.
And Brendan, this also speaks to the very formula that they use to craft these reciprocal tariffs. It's about bringing trade deficits down to zero. So is there really any scope for these countries to negotiate?
Not in the short run. The long-term goal is to reduce those trade deficits that the U.S. has with its bigger trading partners like Vietnam, China, Europe, and Canada and Mexico. But those aren't going to be fixed overnight. And what the administration is talking about is, a complete overhaul of the industrial base of the country. They would argue that these tariffs will form a protective wall around manufacturing, and that jobs will be created, investment will flow in. So it's that's their longer-term goal. But the problem now is surviving the short-term shocks to the system that we're seeing transmitted through financial markets. That and ultimately, the American consumers are going to start feeling the pain, and we'll see if that translates into pressure on Republicans to convince President Trump to scale these back in some way. But in the meantime, they're going to have to ride this storm out.
And it's pressure throughout the world. The Nikkei also on course for a bear market. China's stocks down sharply after reopening from a Friday holiday. Alan, I want to bring you into the conversation on that. It is painful globally. The Chinese unveiling reciprocal tariffs on Friday. What has been the response so far?
Well, today the Chinese market had some of its worst days since the Asian financial crisis back in 1997-98. So the market response is loud and clear that they don't think China and the U.S. could strike a deal anytime soon. What's also very important is that earlier today, China's official newspaper, People's Daily, published a front-page editorial basically calling the Chinese people to dig in. That editorial says that China should no longer harbor the illusion of striking a deal anytime soon. And it also vowed that China will support the domestic economy by stimulating domestic consumption, and also hinting that China could cut rates and the reserve requirement for banks to support lending in the coming days and weeks. The timing was uncertain, but China is now signaling that its domestic economy is ready to take whatever the Trump administration might give it.
At the same time, I mean, we're so different from where we were at the inauguration when China sent one of their top envoys to witness Trump being sworn in as president. Alan, just how frayed are the lines of communication now?
Well, China's leader and Trump haven't spoken since Trump returned to the White House. Later in April, we know that China's officials, not President Xi Jinping himself, will travel to D.C. for some meetings at the IMF. So there might be a chance for some officials to cross paths, and maybe they can talk things out a little bit. But we don't expect any high-level exchanges anytime soon, just because both sides seemed to be, at disagreement about what concessions they could offer one another.
Right. Well, that's Asia. Europe also under the pain today. European stock 600 down nearly 6%. Oliver, what are we expecting from the Europeans? Might we get reciprocal tariffs, retaliatory tariffs rather, from them at this moment as we look at European markets also melting down?
Yeah, Danny, probably not in the immediate term, but what the European sort of leaders and policymakers need to do here is to come up with a coherent and a critically unified solution. We have the Italian foreign minister who's right behind me now speaking to journalists, and there are a number of people who have streamed in over the last sort of few minutes, and I'll just give you an example of where the divisions sort of lie. We had at the same time Robert Habeck, the German economy minister, and we also had Simon Harris of Ireland, who deals with all of their trade issues. These are the two countries that run the biggest trade deficit with the United States. Robert Habeck from Germany is saying that basically you need to start putting everything on the table. This anti-coercion instrument, this is a new law within the European Union that's been around only for a few years, has never been used, and is really seen as the extreme option. He says you need to put this on the table. He has likened Trump's tariffs to the invasion of Ukraine, and that the response needs to be commensurate, while at the same time you hear from the Irish saying that basically the number one goal needs to be not escalating the situation, and that using that instrument would be the nuclear option. These are the kinds of conversations that are going to be coming up right now in the next few minutes behind these closed doors in order to try to get a conversation about how to bring Donald Trump to the table. But listen, Danny, as you just sort of highlighted, listening to the Treasury Secretary, listening to the Commerce Secretary, listening to Donald Trump, this does not necessarily sound like an administration that is in any hurry to come to a deal. That is, of course, what the European Union would like. This is a $1 trillion trading relationship. It is not clear that they're going to be able to get that, so they need to put all of the options on the table and have a menu available for the worst-case scenario.
And even if they could negotiate, who's to say that they could get it done in 48 hours' time when those reciprocal tariffs go go on. Brendan, Oliver, Alan, thank you so much for joining this morning for your team coverage on global reactions to tariffs. Let's get you some other top stories that are trending on the terminal this morning. President Trump says that China's objections to new U.S. tariffs have stalled a deal to sell off TikTok to keep it operating in the U.S. Before he announced widespread tariffs, a deal was reportedly close. Trump previously has said he would be willing to cut a deal with China to lower tariffs if the country agreed to a TikTok sale. As Japan's Nikkei enters a bear market for the first time since August, Prime Minister Ishiba told Parliament that he would strongly urge President Trump to drop the planned U.S. tariffs on Japanese imports. Sources say Ishiba is trying to hold a phone call with the president as early as tonight. Bill Ackman and Stan Druckenmiller have slammed President Trump's decision to launch expansive global tariffs. Ackman says the new trade regime is a mistake. Druckenmiller expanded on criticisms he made of the policies from an interview in January. Bloomberg News couldn't independently verify Druckenmiller's account. Coming up, yields drop, carnage continues in global stock markets. Iain Stealey of JPMorgan Asset Management joins us next on your Bloomberg Brief. It's your Bloomberg Brief on this Monday morning. I'm Danny Berger in New York. A quick check on your bond market. Yields falling globally here in the U.S. We're down nearly 14 basis points on the front end. At what point that was 22 basis points lower. So we've come off the biggest gains of treasuries, but still trading at the lowest level since September of 2022. Your 2s and 10s now below 4%. Pleased to say that joining us now is Iain Stealey, Fixed Income International CIO at JPMorgan Asset Management. Iain, first of all, thank you for taking time off of your desk. I know that it is probably hard to find in this environment, but look, it is a market in panic, but it is a difficult task. We are in the land of economic theory. What does it look like to live in a world where the U.S. tries to take the trade deficit to zero? How do you even begin to think about pricing that in and what the world looks like at that point?
I think you've got to consider what was expected versus now what's happened. And the reality is it was significantly more aggressive than the market expected. We've seen that come through. We've seen this huge shift in sentiment, particularly in risk markets. The Treasury market is obviously a big beneficiary of that, as you've just mentioned. And the reality is until something changes, until we get either a pullback to some extent from the administration, or, as you earlier mentioned, from kind of what Jerome Powell has to say and what the Federal Reserve has to say, the reality is the market's going to continue to be very unsure, very uncertain about what's going on. And I think we're going to continue to see an amount of pain in the market. And that, again, is going to be supportive for fixed income.
Well, Iain, you've said that the risk of a recession is 50%, but we're not pricing in 50%. What does it look like to price in even odds of a recession?
I think what you've got to say is we now have a significant amount of cuts being priced in from the Federal Reserve. Now, will they be able to go through with that? Again, we saw Jerome Powell and what he said on Friday. But I think the reality is if you continue to see weakness in financial markets, if you continue to see a tightening in financial conditions, that's very important. And ultimately, it feeds into the hard data. Then the reality is they will have to move. They will have to be in line with what the market is expecting or pricing, and possibly even further. And then the question will be around risk markets. We've seen a big correction into bear territory within the equity space. Credit spreads have widened, but we could still see some weakness if we continue to get uncertainty around policy and how it's going to be going forward.
Iain, I actually want to take a listen to what Powell said on Friday. Here's what he said as markets were in the midst of a meltdown.
Our obligation is to keep longer-term inflation expectations well anchored and to make certain that a one-time increase in the price level does not become an ongoing inflation problem.
Again, Iain, the market was melting down and Powell was talking about keeping inflation expectations anchored. Is this now a reactionary Fed that will not be cutting until it sees the whites of a recession's eyes?
Yeah, I mean, I think he is in a difficult position. There is a bit of a pickle going on because ultimately they are going to have inflation higher than they'd expected, a lot higher than their target. But I still think they will focus on the jobs market. I still think they will focus on the economy. And if you do start to see weakness in it, then I think that's what they will be reacting to. I think they will step aside and they will say this is a one-time price shock. But the reality is, if you are going to see people losing their jobs, if you're going to see GDP going into negative territory, they're going to have to react, and they're going to react aggressively. And we know that they do that when we look at what their response has been during past recessions.
But given the response of what usually happens in past recessions, Iain, you usually get an addition to deficits, maybe another 5%. We're already running something like a 6 to 7% deficit. So you're talking about huge debt levels. If we do enter something that looks like a recession, does that cap how attractive treasuries are in this environment if we're going to a cost push type of recession and inflationary environment?
I think what that argues for is that you'll be looking at a steeper yield curve. What you'll be thinking about is that the front end of the yield curve, as we're seeing today, that will be reacting to what the Federal Reserve is going to do. That will be reacting to the Fed cutting rates more aggressively. But as you are completely correct, the long end of the market, that might not be as supported. It might not be as attractive, particularly to overseas investors. So I would be very supportive of the yield curve steepening, and I think that's what we're seeing today. I think that continues.
I want to stay on that point of overseas investors because the dollar hasn't been strengthening as much as you might expect. Yes, slightly stronger today. It is weaker versus the euro, slightly stronger on Friday. It was weaker on Thursday. Does this represent a type of paradigm shift where you don't get that dollar smile that we're used to? And does that mean that global flows that usually came into U.S. markets, that usually came into bonds, that they cease to go on because you don't have that hedging property of a stronger dollar when you have risk off?
No, I think that's a really good point. And actually, our currency team have been looking at it as what they're now terming the dollar smirk. So we're not seeing as aggressive dollar support when we're seeing falling in risk assets. And that's partly because we've seen so much money flow over into the dollar, into the US over the last few years. As that comes out, as some of the question marks around what's going on in the US, as that demand for US equities, for US assets does start to fade, people are going to be looking, investors will be looking at other areas around the world, looking at some of the valuation of the dollar, which still looks pretty overvalued compared to long-run averages, that maybe we're not going to see that level of support for the dollar during these times of stress. And people will be looking at other parts of the market. And as you said, we've seen the euro, we're seeing the yen, we're seeing the Swiss franc, other safe haven markets. Perhaps that's where capital will flow to when there is these levels of concerns.
Iain, some huge changes to grapple with, more than we have time to do this morning. Iain, thank you so much for joining us. Iain Stealey of JPMorgan Asset Management. A quick check on markets as we head to the break. As Iain mentioned, we are getting a bid to bonds. The longer end not doing as well as the front end, though. We're lower by about 7 basis points on your 10-year yield. S&P 500 futures fall another 4%. If it opens up this way, we will be in a bear market. Coming up, we're going to look at headlines from around the world as we grapple with tariffs and try to analyze them. You are watching Bloomberg Brief. Welcome back to Bloomberg Brief. I'm Danny Berger in New York. Let's look at the front pages this morning, and it is all about tariffs. Everybody leading with this. The New York Times is leading with the market story saying expect more declines in markets when trading starts in the U.S. in a few hours' time. In oil markets, prices have fallen about 4%, adding to steep losses last week. They also note that CEOs have begun to warn consumers that they should expect prices to increase on some groceries, clothes, and other products. Here's how the Wall Street Journal leads with tariffs. They say that as markets swoon, countries flock to negotiate. Trump spent much of the weekend out of sight in Mar-a-Lago. He did post on Truth Social Saturday saying, hang tough, it won't be easy, but the end results will be historic. He has posted on Truth Social more than 40 times since the tariff announcement, but he hasn't given formal remarks aimed at calming the markets and instead has basically said he didn't engineer the market sell-off, and you got to stick with it. Now, the Washington Post, here's how they lead on tariffs. That the Trump administration officials blitzed television network Sunday to defend the president's massive tariffs. Treasury Secretary Scott Bessent dismissed predictions about a recession on NBC's Meet the Press. Meanwhile, White House senior counsel Peter Navarro said on Fox News not to panic. To be clear, the overriding message from all Team Trump has been, we're Reciprocal tariffs are coming on April 9th. And here is the markets trying to cope with that. You're looking at commodities selling off. Copper has been so volatile. At one point, it was down 7%. Then it pushed positively. It's down nearly 1% again. NYMEX crude down 4.3%. Global equities selling off. Coming up, we talk stocks. More losses piling up on Wall Street. From our global headquarters in New York City, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Tariff turmoil, futures plunge alongside global stocks from Shanghai to London. Traders price in 5 rate cuts over the next 12 months. Take the medicine. President Trump brushes off fears of market routes. Treasury Secretary Scott Bessent sees no reason to price in a recession. Meanwhile, Morgan Stanley sees U.S. stocks dropping as much as 8% further. Goldman Sachs boosts its recession probability. Panic on Thursday, panic on Friday. Welcome to Monday. Another day of panic, another day of selling. Your S&P 500 future session off by nearly 4%. It is over 4% for your NASDAQ 100 and Russell 2000 futures. If we open up at these levels, we will indeed be in a bear market for the S&P. We are already there for the NASDAQ 100. But how do you price in a complete reordering of American and global trade? This is the market trying to figure that out, or at least selling stocks and buying bonds. Your 2-year yield down 11 basis points. We're pricing in 5 rate cuts over the next 12 months. Your 10-year yield, that is at 3.9%. But as we were just talking about with Iain Stealey of JPMorgan Asset Management, the long end will underperform because of ballooning deficits in a recession, if indeed that is the way we are going. A quick look at FX. It is haven buying the yen, outperforming this morning. The dollar weaker versus the euro. The dollar having a hard time holding on to gains. Are we now in a dollar smirk instead of a dollar smile? Well, to our top story, the only cure is tariffs. That's what President Trump had posted on Truth Social last night. The White House wants to reduce financial deficits with foreign trading partners. And for now, a market sell-off doesn't seem to be swaying the president or his closest advisors.
What's going to happen with the market, I can't tell you, but I can tell you our country has gotten a lot stronger. And eventually, it'll be a country like no other. It'll be the most dominant country economically in the world. But sometimes you have to take medicine to fix something.
Joining us for the latest is Bloomberg's Brendan Murray, who leads our coverage of global trade. Brendan, the question this market is asking this morning, is this about reducing tariff barriers and making global trade more free, or is this about taking the trade deficit to zero? Which does it seem like at this point?
Yeah, it seems like the latter at this point. The only real dovish comment over the weekend we got about trade was from Elon Musk talking about how the U.S. and Europe should be a free trade zone. Everyone else, including the president himself, dug in their heels and weren't apologizing for the fact that the market is selling off in the way it is, and that they are pushing ahead with this fundamental change in the U.S.'s trading relationship with the rest of the world. That's going to cause a lot of short-term dislocations for the dividends that they think can pay off down the road. More jobs in manufacturing, investment flowing in, and the U.S. becoming an industrial powerhouse again to rival China. So I think the markets seem to be reflecting is that this is not going to be an easy, good thing for the economy. The president has said trade wars are good and easy to win, and I think we're finding out the opposite is true.
We've also learned that the phone apparently has been ringing off the hook of those trying to negotiate with the Trump administration. Brendan, what do we know about any negotiations and whether any of it looks like it might be sticking or working?
Yeah, look, so those phone calls can take place over the next few days, but that's not going to get around the fact that 10% tariff on every trading partner has already taken place, and much higher levels. China's 34%, Vietnam's 46%, Japan and Korea at the mid 20%, and Europe at 20%. Those are kicking in less than 48 hours, and it's going to take a lot of deal making expertise to get any sort of relief from those taking effect, given the attitude of the Trump administration, which is let's let these take effect, and then we'll start negotiations from there.
Yeah, and Scott Besson, speaking to Tucker Carlson, said I wouldn't even be watching country negotiations. I'd be watching company negotiations, really seeming to signal that they don't even care about the countries. They just want to see companies move into the U.S. Brendan, thank you so much for your coverage this morning and every morning. Bloomberg's Brendan Murray. Well, in reaction to the tariffs, Wall Street has been cutting year-end S&P 500 targets left and right. The latest comes from Oppenheimer at 5,950. Goldman's David Kostin saying that the U.S. stock market is yet to price in a recession, writing, quote, the 2022 experience shows that the markets can continue to decline in the face of deteriorating fundamentals, even alongside light positioning. Morgan Stanley's Mike Wilson also says that he sees stocks dropping another 7 to 8%. Let's add another expert voice to the conversation. Joining us now is Alastair Pinder, global equity strategist at HSBC. Alastair, thank you so much for joining on what's another chaotic morning. Yeah. Look, it is so difficult to figure out. This is the stuff of economic theory put into practice. So when you look at an equity market again this morning, down violently, how much more painful could it get?
I think in the near term, it can definitely get more painful. I think, the positioning is definitely signaling to us buy signals. But the thing is, if you take the COVID-19 as an example, what caused the market to bounce was the Fed put and the government coming in. And at this point, I don't think you see any of these things supporting the market in the near term. So I think we're basically in capitulation, and I don't think we have any near-term support for the market. And of course, we have the US earnings seasons coming up. I think that's going to be a complete mess. I think, companies that beat on earnings are just going to be ignored. Companies that miss is going to basically reinforce this US recession narrative. So at the near term, I think it's going to be a very challenging market to be trading.
Okay, so basically it doesn't seem like anything is coming to save us, but when you think about the project that this administration wants to undergo, it is turning around a really large ship to try to take trade deficits to zero, and arguably it's something longer than 4 years of a presidency. So how do you think about what the ultimate end to this looks like?
It's a really good question. From an equity perspective, I think there's a few things that, we're trying to assess here. One is just for the US, which is, how impactful could these tariffs be? Now, look, one of the interesting things I think is that, at the beginning of Trump's administration, he was focusing on this 60% tariff on China or a universal tariff. The fact is that we've gone down this universal tariff route, and that to me is really worrying because the ability for companies to pass on that cost or to use supply chains to navigate this is kind of gone. Everything's just raised up. So US corporates are getting, squeezed right now. And it doesn't feel like this is an economy where they have much pricing power either.
Right.
Now, I do think from a longer term perspective, what we could see structurally is a rotation of flows out of the US into international markets. And I do think we're getting to this point where I wonder whether we're on the precipice of a structural rotation of global equity market flows.
Okay, that is interesting because, again, if we were to go into the economic textbooks, it would say those with the trade surpluses are the ones that suffer when tariffs are put in. So places like China, maybe even Europe, it's not the U.S., it's those that suffer the most. The U.S. would benefit. Are you saying that when it gets put into practice, it will be the opposite, that it is the U.S. that suffers the most and internationally does better?
Well, it could be, and this is where there's so many moving parts to all of this, right? So take China. They have policy stimulus. They're going to come through. They've already did this at the MPC meeting, expand their fiscal deficit. They've targeted 5% GDP, which means that if things get worse, they can do more. Again, take Europe. Germany's done their fiscal stimulus. They've announced their infrastructure fund. I think you guys in Bloomberg did a great report talking about Europe is potentially doing broader fiscal stimulus as well. And then take the US. Well, the US is actually trying to cut back on their fiscal deficit, right? And so this is where all these moving parts are coming, where it's like at least other countries in the world have a policy offset. And you could say that there is, again, if you're a foreign investor, why would you want to have your money in the US? Why might you not want to, bring it back home? And is there just generally a bigger domestic bias from retail investors globally?
Well, this kind of brings it back to the point about COVID. You mentioned it. The different thing this time is COVID was something we didn't want and something that governments reacted to. This is something the government wants, and as you say, aren't going to provide stimulus into the system.
Completely.
So what does that mean for our understanding of how to even trade this? Is there any sort of historical analog that you can look back to? Are we just in completely uncharted territory?
There's no tariff playbook, to this extent.
Yeah.
And so I do think we're in completely uncharted playbook. And so that's, again, why we're just going to see this market, which is almost forcing, the policymakers' hand to see, like, where is the floor? Like, where is the pain point where the Fed or the government is going to step in and provide support? And what we can see from your reports over the weekend, we don't seem like we're there anytime soon.
So to be clear, if we're not getting it from the government, would you wait to buy any sort of dip until you see Powell seriously talking about cuts?
I mean, I think from a positioning perspective, we could see a tactical bounce maybe tomorrow. But, is that going to be a day? Maybe. Do I think for the next few weeks we're going to sort of see a market that grinds lower? Definitely. And I think, as you say, we need to see tangible, noise from policymakers talking about either a withdrawing of tariffs or the Fed stepping in for markets to feel more comfortable at this point.
Well, so in the meantime, as you say, earnings are going to be a mess. I mean, it is going to be really interesting to listen to these earning calls when you've already have companies talking about force majeure, not filling out their contracts because of that.
Yeah.
What does that mean for this goal of getting companies to come back into the U.S. and building? Is there anyone that's going to be willing to commit the capex to do that right now?
Well, I mean, you've seen that in a number of examples where TSMC, Honda has committed capex to the U.S. and nearshoring or reshoring to the U.S. That would be an interesting development, but it's interesting that that time frame is so long. It's like 5-10 years down the line. So that's definitely something which is problematic. But as you say, I think the real problem for the U.S. earnings season is going into the fact that Q1 is a low earning hurdle to beat. I think it's 7 to 8% Q1 decline, but that doesn't really matter because what we're going to be looking at is guidance, and guidance is just going to be either withdrawn or, no one, I think, has any incentive to provide positive guidance at this point.
I mean, it is so true. Who cares about Q1 when we are living in a new world right now? Alastair, thank you so much for joining this morning. Good luck for the rest of your week. I think we're all going to need it. That is HSBC's Alastair Pinder. Okay, let's get to some other top stories that are trending on the terminal this morning. President Trump says that China's objections to the new U.S. tariffs have stalled a deal to sell off TikTok to keep it operating in the U.S. Before Trump announced widespread tariffs, a deal was reportedly close. The president previously had said that he would be willing to cut a deal with China to lower tariffs if the country agreed to a TikTok sale. Japan's Nikkei entering a bear market for the first time since August. Japanese Prime Minister Ishida told Parliament that he would strongly urge President Trump to drop the planned U.S. tariffs on Japanese imports. Sources say that Ishida is trying to hold a call with the president as early as tonight. Bill Ackman and Stanley Druckenmiller have slammed President Trump's decision to launch expansive global tariffs. Ackman says the new trade regime is a mistake. Druckenmiller expanded on criticisms that he made on the policies from an interview of January. Bloomberg News, though, couldn't independently verify Druckenmiller's account. Coming up, Tesla extends losses. One of the biggest bulls on the street has slashed his price target by, get this, 43%. We're going to have more on that call next.
You cannot throw away the real possibility that it is a severe recession because there's so many changing parts and retaliatory moves, and Smoot-Hawley it was not the cause of the Great Depression, but it certainly accelerated how painful it was. And so I think about it in probabilistic terms. We talked about the probability of recession. There's also the severity, and the tails for how bad it can be are much fatter than in my prior experience when I was thinking about a slowing economy.
Boaz Weinstein, founder of Saba Capital, speaking for the upcoming series Bullish on Bloomberg Originals with Sonali Basak. Let's get a check on these markets because we are down more than 3% for your U.S. stock future session. When it comes to commodities and oil, we are also down sharply, nearly 4% for NYMEX crude, dipping below $60 a barrel. Saudi Arabia has cut its oil prices, and oil majors also following suit in that decline in the pre-market trade. Joining us now is Bloomberg's Jomana Bersecci. Jomana, it's getting ugly out there.
It's not pretty, Danny. Another 4% almost of declines in the oil complex today. That brings the tally of the last 3 days to 16%. And I thought this was a really interesting statistics from Morgan Stanley earlier today. They put out a note saying that 2-day declines of 12% have happened 24 times in history. 22 of them coincided with a recession. So that probably tells you a lot about what this oil market is pricing in right now. But the catalyst, how did we get here? Well, number one, obviously, the big tariff announcement last week, which caused the market to get quite concerned about the demand outlook, with many analysts out there slashing their forecasts for GDP growth for China, Asian economies, Europe, and of course the US as well. But the second blow came towards the end of the week with that OPEC Plus shock announcement to bring forward the extra production and roll in 3 months of extra production into 1 month. Nobody was expecting that on the streets, and that was the catalyst for that subsequent double-digit decline in the price of oil that we've had over the past couple of days. Now, over the weekend, the negative news flow continued. We also got word that Aramco, which are obviously very influential in Saudi oil markets, have now cut their official selling price of oil to Asian economies by the biggest drop since 2022. And so this tells you a lot also about how Saudi Arabia is thinking about market dynamics here. And there seems to be more emphasis these days on maintaining that market share as opposed to keeping some price stability in the market. And to your point earlier, it's not just about what's happening in the spot oil complex, it's also having huge ramifications on energy names, the energy industry. Many of these shale producers in the US are getting hit as well. You've got names like Halliburton, Liberty Energy down anything between 20 and 30% just in the last couple of trading sessions. So I would say that the mood out there for the industry is pretty negative and downbeat at the moment.
And it also complicates President Trump's goal of drill, baby, drill if you have these energy companies in the U.S. which are suffering so much. Jomana, in this uncertainty, what has been the reaction? What are we hearing from industry players on how they see moving forward?
Yeah, you know, there was an interesting piece in the Wall Street Journal today, and the title was President Trump pledged to bring down oil prices, but perhaps not quite like this. This isn't what the shale producers were really hoping for, especially with this steep decline in the price of oil, which for many actually makes the economics of drilling just not feasible. Many analysts out there are also downgrading their views. Interesting today to hear from Goldman Sachs, the second time in the past week they've cut their forecast for Brent. They now see it averaging $62 by the end of this year, $58 next year, so even lower than where we're trading right now, citing again the possibility of further OPEC Plus supply and the possibility of recession. They've also been upping their recession odds. Morgan Stanley also downgrading their Brent forecast by $5 for this year as well.
Jomana, we really appreciate it. That is Bloomberg's Jomana Bersecci on the latest in the oil market. Let's turn to Tesla now, because shares are dropping in the pre-market session, down 6.5%. They are below they are at $224. If they were to extend, as they did at one point, but below $214, that's the price that Commerce Secretary Howard Lutnick predicted that they'd never fall to again. But again, they did fall to that point at one point this morning. Now, adding insult to injury, bullish investor Dan Ives of Wedbush slashed his price target for the stock by 43%. He cited a brand crisis created by Elon Musk and President Trump's policies. He said, quote, Tesla has essentially become a political symbol globally. It is time for Musk to step up, read the room, and be a leader in this time of uncertainty. Joining us now is Bloomberg's Craig Trudell. And Craig, this is something that Dan Ives had said he would do unless Elon Musk got back to Tesla. Now, there seems to be some reporting that he might slowly be less involved with the White House, but just how tough of a go of it is it for Tesla at this moment?
Well, I think Ives's note just yesterday was really remarkable to me, because just roughly a month ago in early March, he was calling Tesla, one of Wedbush's best ideas, and in his note referred to this stock call being a table pounder. He really viewed this idea that Tesla's sell-off was overdone, that all of this concern about brand damage that Musk was maybe doing was overstated, and sort of look on the bright side of all these things that Tesla has coming. I think he still is really, emphasizing the opportunities that Tesla has ahead in terms of, new product introductions and the hopes that they're going to have a robo-taxi service in the months to come. But he's really sort of changed his tune in pretty dramatic fashion about, going back to that brand issue. And I think his call here last night was really sort of worrying about the idea that in China in particular, that with the level of tariffs that the Trump administration has put on China, that will have some blowback for the company in its second biggest market and lead more consumers to buy domestic instead of buying Teslas.
It just underscores how even executives that are close to Trump, the closest of one being Elon Musk, aren't protected in a world with more tariffs. Craig, we've seen reactions from the likes of Jaguar Land Rover, who's pausing U.S. shipments. What has been the reaction of automakers that rely on the U.S. market so heavily? What are they doing in this moment of increasing tariffs to a level that many did not expect?
Yeah, I think that was a huge development over the weekend because Jaguar Land Rover is, sort of neck and neck every year with Nissan as the biggest manufacturer here in the UK. And for them to go so far as to actually pause shipments to the U.S., which, North America is their biggest market, that's a huge deal for this company and for the parent Tata Motors. And I think it's sort of, indicative of this broader move by the industry the last few days of just total chaos, where you've seen some manufacturers try to cut prices to keep consumers kind of reassured. Others, like Volkswagen, for example, they're going so far as to actually list on the stickers an import fee. So it's really a matter of all over the place chaos for the manufacturers.
Craig, thank you so much. That is Bloomberg's Craig Trudell. As stock sell-off pre-market, we're continuing to look at that S&P 500 futures down more than 3%. HSBC out with a note this morning from Max Kettner saying that we are now in oversold conditions, and you could make the case for a turnaround Tuesday, very short-term bounce, though they say this isn't over yet. You're looking at a 10-year yield that's down 4 basis points. The front end, though, leads lower. We're lower by 10 basis points for your 2-year yield. Coming up, we'll set up your week ahead. Let's set you up for your trading week. Later today, we are going to be hearing from BlackRock CEO Larry Fink. He will be speaking with Bloomberg's Eric Schatzker at 12 p.m. at the Economic Club of New York. Then President Trump and Israeli Prime Minister Benjamin Netanyahu will be meeting at the White House on 1 p.m. And then Wednesday, it is the higher U.S. tariffs that take effect on imports in more than 50 countries and territories, plus U.S. CPI numbers. Those come out on Thursday. A quick look at how stocks are reacting this morning. Another tough day overall, but we're looking at Mag 7 continuing to fall. Amazon, Microsoft, and Nvidia all down at least 3.5%. The banks also under pressure. They had their worst 2 days since March of 2020, falling across the board more than 4.7%. Citigroup, Goldman Sachs down 5%. It is recessionary pricing that we are pricing in. All right, that is it for your brief surveillance. We'll take things from here.